Benjamin Graham's book The Intelligent Investor. You can use the investment advice and expertise in this overview to make the best possible investments for you. In this summary, we will share with 9 investment principles you can learn from. Introduction. Why should I care? Learn how to make investments like Warren Buffett. Have you ever considered making a stock market investment? Many of us have given it much thought. However, because of the financial crises, deflated bubbles, and economic collapses we have seen, the majority of us have been reluctant to act. Intelligent investing, on the other hand, offers a technique to invest in the market without running the danger of losing everything. Intelligent investing adopts a longer-term, more risk-averse strategy to the stock market, as first described by Benjamin Graham in 1949. It also works. Since the publication of The Intelligent Investor, many people have utilized Graham's strategy and achieved financial success. Arguably the most well-known of these is Warren Buffett. Based on Graham's original counsel as well as observations from journalist Jason Zweig, this overview demonstrates how you can develop your own investing acumen. This overview will teach you why it's best to start your investing career with virtual funds, why you should never listen to Mr. Market, and why sometimes the cheapest stocks are the most valuable. Principle 1. Intelligent investors take their time to consider a company's long-term value rather than investing quickly. Investing has a lot of potential for financial gain. But there is a lot to lose as well. Financial history is rife with tales of investors like Warren Buffett who made enormous profits by making the right investments in the right businesses. There are just as many, if not more, tales of catastrophe where gamblers lose everything because they made the wrong choice. Therefore, we must ask, is investing really worth the risk? Yes, it is possible as long as you adhere to the method of wise investment, is the answer. To ensure safe and steady profits, wise investors conduct in-depth study. Speculating, in which investors concentrate on the short-term gains made available by market swings, is substantially different from this. Therefore, speculations are extremely dangerous because no one can foresee the future. For instance, a speculator may become inspired to purchase a large number of Apple stocks after hearing a rumor that the company will soon produce a new hit product. If she's fortunate, her knowledge will pay off and she'll gain financial gain. She stands to lose a lot if the rumor turns out to be false through bad luck. Intelligent investors, however, concentrate on pricing. These investors only purchase stock when it is trading below its inherent value, or worth relative to a company's likelihood of future growth. If you're a wise investor, you won't purchase a stock unless you think there is a likely difference between the price you pay and the profits you'll make as the business expands. Consider this safety buffer in the same way you would a shopping trip. For instance, a pricey outfit is only worthwhile if you intend to keep it for a while. If the quality is subpar, it would be better to spend less money on one that will last just as long. Although the life of a wise investor is not particularly interesting, that is not the purpose. The profit is the key idea. Principle 2. 3 guiding principles can be used to analyze intelligent investing. All wise investors should adhere to the following 3 rules. Before purchasing any stock, wise investors conduct a long-term development and business principles analysis of the firms they are considering investing in. The long-term value of a stock is not arbitrary. Instead, it is directly influenced by how well the business that created it does. As a result, take sure to check the company's financial standing, the caliber of its leadership, and whether it consistently pays dividends or distributes profits to investors. Avoid the pitfall of focusing primarily on immediate profits. Instead, take a broad view by studying the company's financial performance. These procedures can help you get a better understanding of a company's performance without regard to its market worth. For instance, a business that has a low share price right now because it isn't well known but has a track record of continuous earnings is probably undervalued and would be a wise investment. Second, wise investors diversify their holdings to protect themselves from significant losses. No matter how promising a stock seems, never invest all of your money in it. Just picture the horror you would experience if the promising business you invested all of your funds in suddenly made the news for engaging in tax fraud. All of that time and money will be wasted permanently, and your investment will quickly lose its worth. You can protect yourself from losing everything at once by diversifying. Finally, wise investors understand that they will produce steady and reliable income rather than remarkable riches. The objective of the wise investor is to satisfy her own wants, not to outperform the Wall Street stockbrokers. We can't compete with those who make their life through trading, and pursuing quick cash simply breeds greed and irresponsibility. Principle 3. Savvy investors are aware of the significance of stock market history. The history of a stock shouldn't be the first thing you do before investing. That is significant, to be sure, but studying the stock market's history is more significant. A historical perspective demonstrates that the stock market has always been characterized by predictable ups and downs. These variations are frequently unpredictable. Due to the unpredictable nature of the market, investors must be ready both financially and psychologically. Economic crises, like the 1929 Wall Street crash, are a reality and occasionally occur. You must therefore make sure that you can sustain a significant blow. This means that you should diversify your stock holdings so that not all of your investments are impacted at once. Additionally, you ought to be mentally and psychologically equipped to handle a catastrophe. Don't sell everything as soon as danger arises. Instead, keep in mind that the market will always recover, even after the most terrible crashes. While it is impossible to forecast every crisis, studying the market's past will help you gauge its stability. Once you've established that the market is steady, pay attention to the company's past before making an investment. Take a look at, for instance, the 10-year correlation between the stock price and the company's earnings and dividends. Then, take into account the inflation rate, or the general increase in costs, to determine how much you would actually make after all expenses. For instance, if you project a 7% return on investment within a year, but inflation is only expected to grow by 4%, your return will actually be only 3%. Consider carefully if putting in the effort for only a 3% return is worthwhile. A solid tool for clever trading is historical information, so make sure to keep it up to date. Don't trust the masses or the market. Principle 4. Sometimes it helps to think of the stock market as a single individual, let's call him Mr. Market, in order to better comprehend the vagaries of the market. When it comes to individuals, Mr. Market is erratic, gloomy, and illiterate. Mr. Market has significant mood swings because he is susceptible to influence. This is demonstrated in practice by the way the market consistently oscillates between unwarranted optimism and pessimism. For instance, when a new iPhone is announced, people can't contain their excitement. When something interesting is going to happen, Mr. Market behaves similarly, and we can observe this in the stock market by observing how prices rise and consumers become more eager to overpay. As a result, equities increase in price when the market's expectations for future growth are excessively high. On the other side, there are occasions when the market is overly negative and warns you to sell under unjustified conditions. The wise investor needs to quit being a follower of trends and start being a realist. She should also disregard Mr. Market's mood swings. Additionally, when Mr. Market is content, he deceives you into believing that there will be profits in the future. A stock's current profitability does not imply that it will continue to do so in the future. Instead, because demand frequently drives prices to the breaking point, well-performing stocks are more likely to lose value in the near term. Even with this knowledge, it's incredibly simple to be seduced by immediate rewards because we have evolved to easily spot patterns, especially those that indicate future success. In fact, humans are so adept at spotting patterns that even after being shown random sequences by psychologists and being informed that there is none, they will still look for one. Similar to how we fool ourselves into believing a pattern will continue when we observe earnings increasing over time. You ought to be familiar with the fundamentals of wise investment by this time. Based on your particular investing approach, this summary will provide you with some useful investment advice. Principle 5. The portfolio of a defensive investor should be well balanced, secure, and very simple to administer. It's crucial to choose a plan as you begin your investing journey that best suits your personal preferences. You must choose between being a cautious investor and an entrepreneurial investor. We'll concentrate on the defensive investor right now. Risks terrify the conservative investor. Safety is therefore her top priority. She can only accomplish this safety if she diversifies her investments. First, you should invest in both common stocks, which offer you voting rights over important corporate decisions, and high-grade bonds, such as AAA government debt securities. A 50-50 ratio between the two is ideal, though if you're a very risk-averse investor, 75% bonds and 25% equities is also fine. Bonds are more secure but generate less profit, whereas stocks are less secure but may result in bigger returns. Bonds and stocks have varying levels of safety and profitability. Both inclinations are taken into consideration by this type of diversification. Second, your portfolio of common stocks should be similarly diversified. Invest in large, well-established businesses with a track record of success, and to lower risk, consider making at least 10 separate investments. You might think that this diversification requires more work than we initially stated, but don't worry. You'll use the simplicity of choice to simplify things. It's best to avoid reinventing the wheel when choosing common stocks. Align your portfolio with the portfolios of reputable investment funds by looking at theirs. This does not imply that you should acquire trendy stocks and jump on the bandwagon. Instead, seek out successful investment funds and duplicate them. Last but not least, always be sure to use a professional. They are more familiar with the game than you are, and they can help you choose the right investments. If you adhere to these straightforward rules, your caution will sooner or later be rewarded with successful outcomes. Principle 6. Investing is simple if you stick to the formula. Once you've decided which businesses to invest in, you should give yourself a pat on the back. The majority of your job is now finished. All that's left to do is decide how much money you wish to routinely invest and periodically check your investments. You will employ a technique known as formula investing during this time, when you closely adhere to a predetermined formula that dictates how much money you will invest and how frequently. Dollar cost averaging is another name for this strategy, in which you invest the same sum of money in a common stock each month or every 3 months. Set your investments on autopilot once you've identified a stock that you believe to be reliable and secure. Begin by promising yourself that you will invest a specific sum of money, such as $50, on a regular basis. Then use your $50 to purchase as many stocks as you can. The benefit of this is that you no longer need to make an effort. You'll never make excessive investments, and you'll never engage in gambling. The drawback of formulaic investment, however, is its emotional requirements. Even if your target stock's pricing is indeed low and you want to purchase more, you have already restricted your spending to that amount. Defensive investors should nevertheless periodically examine to make sure their investment portfolios are still performing properly. A decent rule of thumb for this is to rebalance the proportion of bonds and common stocks in your portfolio every 6 months. Are my stocks still profitable, you ask? Is the ratio, say, 50 to 50, roughly the same as when I first made the investment? In order to adjust your finances, you need talk with a specialist once a year. Everything you need to begin a career as a defensive investor is now known to you. The tactics you need to employ to succeed as an investor and an entrepreneur are outlined in the next section. Principle 7. Defensive investors and entrepreneurial investors both start out the same manner. You should use many of the same tactics that defensive investors do in order to succeed as an adventurous investor. You will allocate your money between bonds and common equities, much like a defensive investor. The more savvy investor will invest more in common stocks because they are more lucrative, as opposed to the defensive investor who will often choose a 50-50 split between stocks and bonds, yet riskier. And just like the defensive investor, savvy investors ought to seek the advice of a financial planner. The astute investor, however, views her financial planner as a collaborator in managing her finances rather than as a teacher. She is not, therefore, directed by her financial planner. Instead, decisions are made jointly. Innovative investors will experiment with different stock types that have higher risk and better reward in addition to using bonds and common stocks as the foundation of their portfolios. For example, you may have read about a new business and thought it might be the next Google. In other words, it is an incredible chance. You have the chance to invest boldly in this business, but you can only do it with a finite amount of capital. Entrepreneurial investors should keep these stocks to a maximum of 10% of their whole portfolio, regardless of how exciting or enticing an investment opportunity sounds. Keep in mind that even wise investors make mistakes, and that occasionally Mr. Market is too irrational to foresee. Thus, we must set restrictions in order to safeguard our funds in the event of an economic downturn or a bad investment. Like defensive investors, savvy investors are aware that maintaining an incoming profit flow depends on ongoing analysis and portfolio management. Principle 8. The savvy investor ignores the ups and downs of the market. Do you sell your stocks right away if their value drops, or do you hold on to them? Is it a good idea to participate in the activity before it's too late if another stock is rising? Investors frequently take this course of action, known as trading, because they worry that going against the grain may result in financial losses. However, a wise investor is aware of better. Risky to put your trust in Mr. Market. If a stock's price is rapidly increasing, there is a good possibility that it is either already priced over its intrinsic value or that investing in it will be risky. Do you remember the most recent housing bubble in the US? Everyone kept making investments in real estate, and as prices rose, no one noticed that they were already out of proportion to their true worth. But the market fell as soon as it became too clear to ignore. Enterprising investors buy at cheap prices and sell at high prices to avoid precisely this situation. Regularly review your portfolio and research the businesses you own. Consider the following: is the management still performing well? What's the state of the finances? It's best to sell a company in your portfolio as soon as you realize it is overvalued and that its stock price growth bears no relationship to its actual value. On the other hand, you should purchase in undervalued markets. That's exactly what Yahoo Incorporated did in 2002 when it paid just $1.65 a share to acquire Inktomi Corporation. It was a fantastic deal. After Inktomi's shares dropped from the grossly inflated $231.625 per share at a time when the business wasn't profitable, Mr. Market had grown despondent. Principle 9. An astute investor has the ability to uncover genuine bargains. By now, the thought of turning into an entrepreneurial investor ought to sound like an enjoyable challenge. However, is it really worthwhile to put yourself through the hassle of routinely reviewing your portfolio? Actually, it is because those are the places with the best deals, but only if you start out wisely. Start off as an entrepreneurial investor by electronically tracking and selecting stocks. Spend a year investing digitally to enhance your ability to identify deals and monitor the performance of your stocks. There are several websites available today that let you invest virtually. Simply sign up to find out whether you can actually produce outcomes that are above average. This one-year practice phase has many benefits, including releasing you from your lofty expectations while simultaneously teaching you the ins and outs of investing. You've had a year of virtual experience, and now you're prepared to shop around. Stocks of inexpensive companies are the ideal spot to locate a deal. Stocks of companies that are either temporarily unpopular or experiencing financial difficulties are typically undervalued by the market. Imagine Enterprise B is the second strongest competitor in the refrigerator market to demonstrate this. The company is big, and during the previous 7 years, it has produced reliable but unspectacular profits. The company hasn't been as profitable over the last 2 months due to a production issue, which has caused nervous investors to lose confidence and drive down the share price. An astute investor would view these declining prices as a chance to acquire a fantastic deal, since once the production fault is fixed, the company will be back where it was. Finding deals, though, is challenging. That is why it's crucial to practice for a full year before starting. If you can succeed in the virtual world, you can succeed in the actual world as well. Final thoughts. This book's main takeaway is: when it comes to stocks, you should always follow the advice of an informed investor, regardless of whether you want to play it safe or go the entrepreneurial route. You can turn your investments into modest but steady returns by simply adhering to the advice given here. What to read next? Guy Spier's The Education of a Value Investor. You should be able to make wise investments and watch your money start to increase after you have these useful investment tips under your belt. But as you progress in riches, it's wise to keep in mind that money can corrupt. Guy Spier, a well-known investor, had to learn this lesson the hard way. He was a successful Wall Street hedge fund manager at the peak of his career when it suddenly dawned on him that he didn't like who he had become. He had given up his morals in order to succeed in the financial industry. He set out on a journey in order to change. Thank you for watching. If you'd like to purchase a copy of this book, click the link to do so on Amazon. Please don't forget to subscribe, like and share this video with your friends and family.